All right, today we are digging into the latest earnings from spine surgery innovator Carlsmed. Now, they just put up some absolutely eye-popping numbers. We're talking nearly 100% growth. So, you'd think the stock would be flying, right? Well, it wasn't. And that's exactly what we're here to break down.
So this is the real head-scratcher this quarter. On one hand, you've got this incredible near triple-digit revenue growth. I mean, that's just explosive. But then you look at the bottom line, and it's completely dead flat. This tension, right here, between massive growth and zero profit is the story. It explains pretty much everything about the earnings call and why the market reacted the way it did.
Okay, first things first. Let's just quickly run through the headline numbers to see how this all played out. Okay, so check this out. Revenue came in at $12.1 million, which squeaked past what analysts were expecting. But get this, it's basically double what they did this time last year. Fantastic, right? But, and this is a huge but, look at that adjusted EBITDA. It's a loss of $6.2 million. You know what it was last year? The exact same number. So think about that for a second. They doubled their sales, but they didn't make a single extra penny on the bottom line. Every new dollar they brought in just went right back out the door. That's what we call a lack of operating leverage, and that's the big red flag that's got Wall Street on edge.
I mean, you just have to admire that number, 99% growth. You can't argue with that, it's huge. And management was really clear about where it's coming from. It's all about their AI-powered aprevo platform. More and more procedures are being done with it, which simply means more surgeons are adopting the tech and actually using it in the operating room. That's the engine driving this whole thing.
And the CEO, Mike Partin, he kicked off the call by putting that number front and center. You know, he wanted to make sure everyone heard it loud and clear. It was all about hammering home that powerful sales momentum. And you got to give it to him. The top-line story is absolutely rock solid. They are getting the job done when it comes to execution.
But yeah, all of that amazing growth just brings us right back to that main problem, doesn't it? The core tension here is all about growth versus profitability. So let's look at the bull and bear arguments that are shaping up. So if you're a bull on this stock, you are pointing to some really strong stuff. Surgeon adoption is soaring, up 72%. Plus, they've scored some big wins on the insurance reimbursement front, which, makes it a much easier sell to hospitals. But if you're a bear, you've got plenty of ammo too. Gross margins actually went down a bit. Operating expenses are way up. And the big one, of course, is that profitability just isn't budging, even with all that extra revenue. So where is all this money going? Well, here's the breakdown. Look at that. More than half of their operating expenses are going straight into sales and marketing. And honestly, that's not a huge shocker. This is a classic hyper-growth playbook, right? You have to spend money to build out your sales force and get in front of doctors. The rest is getting plowed into R&D and, just the basic costs that come with being a new public company. Okay, so with all these questions about profit, everyone is looking ahead. What's next? For Carlsmed, the answer is simple and clear: the cervical spine. This is their next big thing.
And when we say big thing, we really mean it. This is not some tiny niche market they're going after. We're talking about a market with around 370,000 procedures every single year, just in the US. This is a massive opportunity, and it's absolutely central to their growth plans from here on out. And the good news is they've laid out a pretty clear path to get there. The first big day to watch is October 1st of this year. That's when a really important reimbursement kicks in. After that, we're looking at the full-on US launch in the first half of 2026. Trust me, every single investor following this company has these dates burned into their brain.
So you might be asking, how are they going to convince hospitals to jump on board with this new tech? Well, it all comes down to this number right here, over $21,000. That's how much extra money a hospital can get paid by the government for a single surgery just for using Carlsmed's technology. This is a total game changer. It's not just some bureaucratic approval, it's a giant financial carrot that completely changes the conversation with hospital administrators.
All right, so you've got this wild mix, right? Amazing growth, this huge catalyst coming up, but also these nagging questions about profit. So, what did the market think of all this? Well, the stock's reaction basically told the whole story in miniature. Right after the numbers came out, you saw this little pop, a little bit of excitement, but then almost as quickly it just fizzled out. By the end of the after-hour session, the stock was actually down. We call that a round trip, and on pretty low volume too. It's the market basically saying, yeah, we see the growth, we're interested, but we're not convinced just yet.
And look, this isn't some brand new feeling from the market. If you just zoom out and look at how the stock has done since it went public, it's been lagging behind other medical device companies. So this tells us that investors were already a bit skeptical, already in this prove-it-to-me mode, even before this latest report came out.
Really, it all boils down to this one simple idea. The growth story, it's great, it's exciting, but the market is over the hype phase. Now it's all about the proof. Investors need to see that the company can maintain its margins and, most importantly, that there's a real, believable plan to actually become profitable. So, let's put it all together. What's our take? Here's our rating and what we're going to be looking for next.
Okay, so when you lay it all out, it's like a perfectly balanced scale. In one pan, you've got that explosive, can't-ignore-it growth, plus a catalyst in the cervical launch that could be a huge deal. But in the other pan, you have these really nagging profitability issues and a market that is clearly skeptical. It's a classic standoff.
And because of that balance, we're rating the stock market perform. Well, look, the potential here is massive. That cervical launch could be huge, and the growth is obviously real. But we just can't get past that lack of operating leverage. The risk that they can't execute on turning that growth into profit is just too high for us to call it an outperform right now. For us, Carlsmed is still very much a show-me story. So this leaves us with the one single question that matters most. We know the cervical launch is probably going to drive even more growth, but is it the key that will finally unlock the door to profitability? That is the billion-dollar question, and you can bet that's what everyone will be focused on for the next several quarters.
And of course, a quick reminder. All of this is for your information. It is not financial advice.